when the Prime Minister came out with this, there was a lot of head scratching among folks who follow central bank policy around the globe, but his ideas did not come from nowhere. Can you sort of explain the economic theory that sort of explains this or goes under this?
Yeah. So anyway, when I'd heard him talk about this before, so I thought maybe it was coming out of the blue, but apparently he had. One of his economic advisors had been reading, some things that people have been writing about this lately. So the basic idea is that the conventional wisdom about how we should control inflation is wrong. That in fact we don't increase inflation by reducing interest rates. We increase inflation by increasing interest rates. And in a country like Turkey, where inflation is high relative to their inflation targets, the policy that would work would be to reduce interest rates to bring inflation down.
Professor Williamson, there's an intuitive logic to the traditional framework, which is essentially increasing interest rates makes safe assets and short-term investments more appealing. That decreases the appeal of risky lending. That creates less credit in the economy. Less credit means less activity, reducing inflation. What is the intuitive logic between how your mechanism works, the neo-Fisherian school, which says exactly the opposite?
Well, the intuitive logic is that we have these observations about the relationship between inflation and nominal interest rates. We observe that in times like in the old days, like in the 1970s, and inflation was high, nominal interest rates were high, and now in a time when inflation is low, nominal interest rates are low, and then we mainstream economic theory, asset pricing theory, macroeconomic theory tells us that's consistent with how our models work. Now the intuitive logic is has to do with how asset markets work, and then it's the tendency for real rates of return to equate across assets. The standard intuition would be is not quite the one you said. It's more like a kind of Phillips curve argument.
Fair enough. I admit that the sort of transmission between policy and inflation, people might describe it different ways. So are you suggesting, explain this idea of sort of consistent returns across asset classes. You seem to say two things. One is you say there is the observed reality in which you have periods of high policy rates and high inflation, although it seems possible that it would go the other way, in which you have the high inflation first and then people raise policy to try to fight it. Regardless, but what is the actual connection? So let's say in Turkey you wanted to fight inflation. You cut interest rates. How does that mechanistically cause inflation to go down?
Yeah. So what you do in the short run is so you've lowered the rate of return on government debt effectively at the short end, and then real rates of return, over the medium to long term are tied down by real forces like productivity growth. So what has to happen is, the real rates of return have to roughly equate, adjusting for risk and liquidity, et cetera, So if you lowered the nominal interest rate and lowered the real rate of return on safe assets, then what has to happen for real rates of return to adjust in the short run is inflation has to adjust down, and that's certainly consistent with it's consistent with theory. It's consistent with what we observe over long periods of time.
And is it consistent no matter what country and what central bank we're talking about? In other words, if Turkey is an example of this, is it possible that that theory applies in some cases, and the more traditional view of higher rates, lower inflation, and vice versa applies in other situations?
No. This is just a basic. It's just basic economics. So this applies everywhere. I've not seen a case where it doesn't appear to apply. And there are lots of other forces, so at play in determining what inflation is, So there are many things going on other than just monetary policy in determining inflation, but this doesn't have anything particular to do with particular circumstances of Turkey or with the Turkey versus the United States, Turkey versus Japan, et cetera.
Professor Williamson, one thing anyone I think would certainly grant you is that the low interest rate policy we've seen in recent years has certainly not catalyzed inflation as many people would have expected. So that, I think, is certainly damaging to the status quo. The canonical example of higher rates reducing inflation has to be the Volcker era in the United States, massive increase in rates in the early 80s, and then inflation sort of coming down. What is the main, in sort of seeing cause and effect, what is the main error that people look at when they're examining that behavior in the early 80s?
Yeah, so that's a myth. The myth. That's the way people always tell the story. It's that they tell the story as if what Volcker did was to raise interest rates, which brought inflation down. So if you look at what Volcker was doing, so it's interesting to go back and read the minutes of the FOMC meetings and see how Volcker and his committee actually thought about what they were doing. So they were monetarists, so they essentially adopted a kind of Milton Friedman approach to reducing inflation. They were sold on that, and so the whole approach was reducing money growth to reduce inflation. They kind of abandoned the idea that they were going to even pay any attention to market interest rates during that regime. So, and if you look at the data, then effectively what happened was that over the course of Volcker's tenure, what happened was that in fact inflation came down and nominal interest rates came down. It's completely consistent with the story.